Oh, Scott, call for him. Scott.
Good afternoon, ladies and gentlemen. I'm Megan Olson with the Investment Advisor Association, and I welcome you to our webinar, Proceed at Your Own Risk, Recent Trends in Enterprise Risk Management. During the webinar, all participants will be in a listen-only mode. You may submit your questions to the speakers at any time during the webinar by typing them through the chat feature. Only the speakers will see your questions. Questions will be addressed as time allows. As a reminder, today's webinar is being recorded July 15th, 2020. I would now like to turn the presentation over to our moderator, Laura Grossman, Associate General Counsel at the Investment Advisor Association. Laura.
Thank you, Megan, and welcome everyone to today's webinar. Today we're going to be talking about different approaches to enterprise risk management, as well as COVID-19 related hot topics and best practices. We have an excellent panel today that I'd like to introduce. We have two pairs today, two sets of pairs. We have two speakers from Wilkie Farr & Gallagher law firm. We have Barry Barbash, who is Senior Counsel in Wilkie Farr & Gallagher's Asset Management Group. He's in Washington, D.C. and New York. And some of you know that he's a former director of the SEC's Division of Investment Management. Also joining us is Barry's colleague, Ann Cho. Ann is a partner in Wilkie's Asset Management Group in Washington, D.C., and she has significant experience with mutual funds, fund independent boards, ETFs, private funds, and their sponsors and investment managers. And then we have two speakers from an IAA member, Guggenheim Partners. Joe Bershinger is the Chief Risk Officer of Guggenheim Partners, and he's very involved in identifying, measuring, and monitoring, and proactively managing and advising on potential risks. Joe will be providing his in-house perspective as Chief Risk Officer. And Joe's colleague, Rob Saperstein, is the Global Head of Compliance and Senior Counsel for Guggenheim. Rob has oversight over the compliance programs for Guggenheim's registered investment advisors, registered investment companies, broker-dealers, commodity trading advisors, and business development companies firm-wide. Rob is here to speak to compliance-specific issues associated with risk management. Their full bios are at the end of the slides. As Megan noted, we do encourage you to submit questions, and we'll try to get to those as we go along. So, as I said, today we'll be talking about how do panelists define enterprise risk management, why it's important and recent trends, who is responsible for this function in an organization, and different reporting structures that you can have, sample governance structures and issues such as centralized management versus separate committees, defining and measuring risk appetites, tracking data indicators and metrics, how the business continuity plan fits into the broader enterprise risk management program, and special COVID-19 issues, including so-called new risks that firms are considering adding to their ERM, how to improve your risk matrix given the work from home environment. So with that, I'm going to start with Barry. Barry, how do you think of enterprise risk management?
Thanks, Laura. I thought it would be a good idea in the context of this presentation to see if I could write what I thought enterprise risk management is in about 25 words before we get to the first slide. So what I came up with was it is a strategic approach, meaning it's an active approach with some notion of a goal and working through that goal, but it's a strategic approach to identifying, analyzing, and dealing with risk by an organization. Risk being defined as internal and external factors that affect how well an enterprise, a company, can meet or exceed its stated goals. That's reflected, that definition is reflected in our first slide for today, in the definition. So we talk about it being a coordinated effort. It's clearly an effort by an entire organization, across the organization, to first go out and identify assess and mitigate risk within the organization. In terms of what's risk, it depends on the business. I tend to think of risk as those activities or situations that could place the viability of an organization in jeopardy. That's one way of looking at it. I think also I tend to look at it as those activities, those situations that could end up putting a company on the front page of the Wall Street Journal, first page of the business section of the New York Times, something about what's going on with the company that has an adverse consequence potentially. The notion of enterprise risk management contemplates lumping together, considering together all the control functions within a central framework, looking at them all together and the interactions of the control functions. It contemplates an analysis of all of the key functions or activities of a company, as the slide indicates: financial, investment management, organizational, operational, marketing, distribution, and personnel. In the context of a specific business, for a money management firm, it might mean not just personnel, but it also means how a company goes out trading securities, what its advisory functions are, what's its dealings with counterparties, how does it go about following its models if it follows a model in connection with investment management. But all of the segments are considered. As part of an enterprise risk management analysis, it's clear that what's identified by some group within a company is to focus on discrete activities. And typically, enterprise risk management contemplates a quantification of the risk, looking at the probability, the severity, the overall level of the risk, not being all that numbers oriented or risk oriented when it comes to numbers. I always think back to the time of long-term capital management in the asset management area, where you had all these wonderfully skilled Nobel Prize managers who were all together and thought that they had risk down to a science, literally, and had all these theories of risk, and then ended up being taken out and being sidewinded by something they never expected. But clearly there is this notion of trying to quantify the risks involved in a business. In a typical situation, an example, as the slide indicates, what you have if the company's going to engage in enterprise risk management is some kind of risk team, risk group that acts as the coordinator, getting input from the various control functions, compliance, internal audit, corporate finance, investment management, thinking it all together and trying to make an evaluation of what the risks are. As I thought about today, I asked myself the question, how many companies think about enterprise risk management? And I went out and I took a look, and I came across a report that was put together, or a survey that was put together by the AICPA, the American Institute of Certified Public Accountants, back in 2018, not that long ago. And that survey indicated that fewer than a half of the surveyed C-suites, the chief executive officer, chief financial officer, those kinds of folks, those kinds of managers, fewer than half formally considered a risk analysis, or to engage in a risk analysis and considered risk exposures when they were evaluating new opportunities. That seemed to me to be low, but I take it as a given that maybe enterprise risk management hasn't quite taken hold as much as I would have thought it has. I also noted the same survey said that only 26% of boards considered enterprise risk management that way. I think that the trend, though, in the money management business and the trend in the financial services business generally is to start looking, or to continue looking, at enterprise risk management and using the concept of enterprise risk management as part of an important analysis. We're seeing more of it, which raises the question, which I'll turn over to Ann, on why enterprise risk management is important these days.
Thank you, Barry. So turning to the next slide, why is enterprise risk management actually important? And as I prepared for this webinar and I thought about why ERM is critical, I came across an old speech by a former director of the SEC's Office of Compliance, Inspections, and Examinations, where the former director said, a corporate culture that reinforces ethical behavior is a key component of effectively managing risk across the enterprise. And so that got me thinking. And enterprise risk management is not strictly about compliance with legal or regulatory obligations. It's really about setting and establishing an important tone at the top at the organization and really making sure that your firm doesn't come out at the front page of the Wall Street Journal, like Barry had mentioned, in managing risk effectively. And so there are certain key audiences when it comes to having an effective risk management program. The first one being the regulators. As legal counsel, we're often focused on how to make sure our investment advisor clients could be potentially found liable in connection with their risk management. And so one of the principal ways that could happen is if the advisor actually markets or discloses to others that they have a risk management program that involves certain elements, but in fact, they're not actually implementing those elements. So there, the regulator could allege an action for fraudulently materially making a material misstatement about the advisor's risk management program. I won't go into a particular case in too much detail, but I did want to reference it for the audience's purpose if they want to research this later on. It's an enforcement action against this entity called Catalyst Capital Advisors in January earlier this year. In there, the SEC alleged that the advisor misrepresented their risk management stop loss procedures and triggers in connection with portfolio management and brought an action against that advisor. Now, another potential area of liability for an advisor would be substantively involving the Advisors Act compliance requirement under Rule 2647. As a note, many of you in the audience are compliance professionals. This requires an annual review and assessment in making sure that the advisor has adopted appropriate policies and procedures reasonably designed to prevent a violation of applicable law. Now, risk management can play a critical role in your annual compliance rule requirement because an advisor could face a potential regulatory action if the SEC, for example, asserted that your risk management program should have actually identified a potential gaping hole in the prevention of a particular law or regulation, and it failed to meet that requirement. So it's a more substantive potential allegation, I think harder for the SEC to bring that type of action than the first one that I mentioned, but still something to keep in mind. And another, sure.
Yeah, sorry, I have a question about what you were just referring to. So 20647 are typically brought, when there is a substantive failure, and then the staff will further allege that you didn't have adequate policies, procedures, and controls from a compliance standpoint, because 20647 is usually directed at your compliance. In fact, it is directed at your compliance program. So an interesting question is, in ERM, when we're talking about much broader risk than just compliance, talk about operational risk and financial risk and all different types of risk. Could a 20647 case be brought if there was, an inadequate risk function in terms of from a portfolio management standpoint, like Barry mentioned, long-term capital, as opposed to a compliance failure?
I think it could potentially be brought if there was an actual violation of a particular law, right? So if the SEC found that you had mismarketed your risk management program, I think they could bring it under the fraudulently presenting a material misstatement, but also saying you don't have adequate policies and procedures around your marketing process, that you didn't catch that particular action. So I think it's going to be harder for the SEC to bring that type of substantive action, but I don't think it's out of the realm of possibility.
I don't think you necessarily see it as much in enforcement actions. I think where you do see the SEC get involved with risk management is in connection with some of its rules. For example, you now have in the mutual fund area a liquidity risk management rule. And then more recently, the SEC has a proposal outstanding for mutual fund valuation, where one of the concepts that needs to be incorporated by a mutual fund directors or the advisor, if assigned the responsibility, is the notion of valuation risk management, which I think, Rob, are broader than just compliance. So you see the SEC getting to look at those concepts of risk management. And I think in the course of exams, they look more broadly. But I think Ann's right. I think you can have an action, you can have an enforcement action under 206-47 for a procedure that's off. But I think that would be more compliance oriented than broader.
Mm-hmm. Great point. And another regulatory proposal that's in the mix is the SEC's derivatives rule as well for registered fund complexes. And they're similar to the liquidity rule. The SEC is going to mandate a particular risk management function to address those requirements. So who else and why else is it important? So it's important from the fund board perspective, and also if you have a parent company board, because they're focused on obviously an advisor's risk management program. And also clients and prospective clients are keen on risk management programs. And this is also in the case of third-party business partners, where you could have a broker-dealer that sponsors a wrap program, and they're onboarding third-party advisors, and they will look at an advisor's risk management program as a part of their third-party service provider oversight. So recent trends, themes, frequency, materiality, what are we seeing currently? So as a general matter, risk self-assessments are typically conducted on an annual basis, but they may occur more frequently for particular high-risk activities. There could also be certain inter-period risk assessments if there are volatile market conditions, similar to what we're experiencing today or in March and April. So that's what we're seeing, but maybe I'll ask Joe as our Chief Risk Officer on the panel, are you seeing any other themes in terms of your self-assessment of risk management?
So, yeah, it's a good question. I think, themes on self-assessment, there's really two schools of thought. One is where the risk team goes out and actively does the assessments themselves, partly in order for them to learn the business, learn the activities of that. Second school is to have the specific functions actually do their own self-assessments. I would say that there is no right or wrong way. A lot of it depends on the expertise of your risk team, the size of the firm, the resources available. But certainly, frankly, I prefer where the actual business functions themselves do the assessments, since they own those processes, they own those activities, and so therefore they need to own up to responsibilities in identifying all the risks associated with those. So that is a common theme.
Great, thank you.
And if I could go back for a second to your point about boards being involved with enterprise risk management. Ann and I have a client in the fund area where the board we deal with is incredibly focused on risk management. It's their number one question whenever they're involved in looking to approve an advisory agreement between a fund, a registered investment company act, and an advisor. They're always interested in the risk management systems, enterprise risk management by the advisor. They ask an awful lot of questions for it. It's a big focus. I tend to think that the board members come from an institutional investor background, and institutional investors focus an awful lot on risk management. It's typically a question, for example, in a due diligence questionnaire when an institutional investor wants to make an investment in a private fund, not as much in a mutual fund, but in a private fund, a hedge fund or a private equity fund, one of the questions that will be raised by the institutional investor is, tell us about your risk management. Now that's a place where I think a lot of times clients don't realize that there's a potential liability. If you set out in response to a due diligence question that as an enterprise, you have a risk management system and you follow it, and it turns out that something goes wrong and the facts would show that you didn't follow what you said in a DDQ, in response to a DDQ, that could support a case under the federal securities laws on a fraud theory. So that's an area. We see a big focus by institutional investors on enterprise risk management. It's a very hot topic for them. And oftentimes that's what we spend a lot of time with on answering due diligence questions, is spelling it out, which raises the issue of should a manager be prepared to answer? Yes, and a manager needs to be in a position not only to have an answer, but make sure that the answer is absolutely accurate, because it can call into question your process if it turns out that it weren't accurate answers.
Yeah, Bear, I think I agree with that. Having, served as a chief risk officer, within the industry for almost 20 years, really have seen a shift, in the culture from, 18, 20 years ago when I started doing this. There were very few, chief risk officers that are within the asset management industry, but now over time, institutional investors, large asset allocators, oftentimes once they meet with the investment team, they understand performance, how they're going to generate alpha. The next team they want to meet with is the risk team, because they want to understand what controls are going to be in place to mitigate and monitor their investment. It's a very, it's really come to the fore for not only boards, but also for the institutional investors, as you indicate. If I can just add one more point on the regulatory front, I think Ann brings up a very good point there. In the past, I would say 5 to 7 years, I've seen a shift where the regulators actually do want to interact more, more with risk team members, primarily because, as a risk officer, you can only manage risk if you understand the business, and oftentimes, they will prefer to go to a risk officer because it's a single point of contact. And so, you mentioned the three laws: liquidity rule, derivatives rule, and obviously the fair value rule, which is in process now, or under comment. In all cases, they're looking for responses from risk teams, in addition to investment professionals on all those. So I have seen that sea change for the regulators.
So I think that's a good segue into talking about who is responsible for ERM within an investment advisory organization. Can you speak to that? Sure.
So a lot of the the organization and the governance around where this function should live, it depends on a few things. One is the size of the organization. Clearly, if you're a small asset manager, broker dealer, you may have to wear a couple of hats. I've seen some smaller shops, private equity funds, 10, 15, 20 people, where the CCO is also the chief risk officer, or wears is dual hatted to some extent. And obviously, much larger organizations, you see more formal enterprise risk organizations where you have a chief risk officer, you have a team underneath that person. Typically, they will report up to a CEO or a president. It's rare that they report up into a CIO, obviously from a conflict perception matter. It's much easier for a CRO, or it looks better for a CRO to report up to a non-investment staff. From my perspective, the CRO should be able to, say no to the CIO if they believe there is something, incorrectly going on, or they don't agree with the decision. in addition to that, I have seen structures as well. There's the best practice where the CRO has a dotted line responsibility into the general counsel of the firm, the chief compliance officer of the firm, the head of internal audit for the firm, and that they hold regular, formal meetings with them to share ideas, observations about, the workings of the business, of the organization. Again, some of the reporting structures depend on the complexity of the business. So again, larger organizations, the risk team will often get involved in a much broader set of activities or high-risk activities. Barry earlier talked about, the firm has a number of activities. You need to identify what those activities are and prioritize a risk for those activities. And so those activities could include trading, obviously valuation, pricing, counterparty, best execution, even some of the regulatory outreach. The risk team will take ownership and be actively involved in all those activities to ensure that the right focus is on those as they are high-risk activities. And oftentimes, we will pair those committees, if you will, control functions with members of the compliance team or the legal team to ensure that we've got continuity in the control function across the high-risk activities within a firm.
So Joe, just following up on one of the things you said, the ERM function, which coalesces all these control functions together, at least so that they're communicating and evaluating risk across, the different silos. My question is, you're sort of, as the chief risk officer, you're saying, yeah, it kind of belongs in risk, and risk can communicate with audit, and risk can communicate with compliance and operations. I'm just sort of positing that it also could theoretically sit in compliance as a compliance officer, meaning
absolutely
compliance could oversee the ERM function as long as it's having that communication and direct contact with all those other control functions.
Absolutely. Again, I've seen it report up to the CCO. I've seen it report up to a president, a CEO. I've seen it at times report up to a board, where the board actually interacts with the CRO on a monthly, quarterly basis. So, as long as there is independence from the investment teams or the investment side of the business, and then as long as we've got communication, amongst all the control functions, it can really report into any control function or the lead of any control function.
The distinction that Joe made about small versus large organizations really is of consequence. I think personally that the regulators tend to think that every organization has separate groups. And as Joe is suggesting, that isn't necessarily the case. You could have one person function in a lot of different roles. And I think there's this notion among a lot of SEC examiners, and I think the SEC other personnel, when looking at a regulated firm, that there really should be a bunch of different people carrying out those roles. And I think there's really nothing wrong with one person having multiple roles, so long as the function works correctly. But I do think there's sort of an inherent bias against smaller companies with one person doing an awful lot of these services. I think the SEC oftentimes thinks that there's some kind of conflict there. I don't really think that is necessarily the case, but I do think that exists out there on the part of the regulator.
Yeah, Barry, I would agree with that. Again, smaller firms, given the nature of their business or their strategy, may have a dual-hatted or a triple-hatted situation. If you have I guess another key factor is the complexity of the business, the types of activities they're doing, the nature of the investments that they're taking, whether they do things in-house or outsource certain activities. I think the regulators would look at the diversity of activities going on in a firm and then make a determination of, is this person wearing too many hats, and therefore, maybe not being able to cover some of the risk which they should be in an appropriate manner. So you're absolutely right on that.
And then, you know, on the other hand, in a very large firm, you may have hierarchies of ERM. So, you know, there'd be an ERM process, for example, on an investment manager, there'd be a separate one in a broker dealer, and it would all
Absolutely.
fall up to see the ERM, the highest risks from an enterprise-wide standpoint.
Yeah, that's right. That's absolutely correct.
Why don't we switch gears a little bit and talk about some ways to think about ERM governance. We'll start with you, Joe.
Sure. So as a few of us have talked about, you know, the enterprise risk infrastructure of any firm is really unique to that firm, and it's based on a number of factors, you know, including size, you know, nature of their investment strategies, the expertise of their people, the complexity of their business. And so some very standard ones are, you know, operational risk, or just, you know, the basic operations of an investment management firm, processing trades, reconciling cash, reconciling positions, settling trades, generating client statements, things of that nature. Obviously, compliance and legal risks, you know, thinking about the interaction with regulators, ensuring that you have all the appropriate policies, procedures, both internally and externally, culture of compliance, you know, obviously a very strong infrastructure around that. Capital, right? Financial risk. Does the firm use seed capital or balance sheet capital to fund and seed investments? How is that monitored? Is that hedged or not? Credit risk and liquidity risk are two that obviously play a very important role within risk function, you know, in any asset manager. Again, depending on the complexity of the business and the nature of the activities, you could have two separate teams, one managing credit, one managing liquidity. Valuation risk is certainly something which every firm should be focused on. You know, it's just not being able to strike a value for a security each and every day. You have issues about you know, having a hierarchy of various pricing vendors. Some of your pricing vendors may be good at certain asset classes versus the others. How do you balance that? And then obviously, you know, what's the governance around challenging pricing? If you get a dislocated markets or high volatility markets, as we saw in the first quarter, you will see, you know, at times, you know, gaps in pricing, for example. How do you deal with that if you're managing daily valued funds? Obviously, reputational strategic risks. You know, what is the firm doing on a business perspective as far as new products, new channels of business? From a reputational perspective, what is the firm's policies around personal securities trading, political contributions, things of that nature, ensuring that you have a very strong control mechanism, monitoring mechanism around that. The oversight of that can take place in a few ways. One, again, small firm, small risk group, you know, they can report up to the board. Larger firms, it's very common to have an enterprise risk committee. It's often, the way I've seen it, it's often the most senior control function or senior control committee within a firm. General counsel, head of internal audit, chief compliance officer, chief risk officer, senior teams, and then you add people, chief operating officer, head of technology, chief financial officer, and then others are invited based on what gets covered. And they review each control function goes through a standard dashboard, and you want to review all the key metrics or data, key performance indicators, which reflect the quality or the health of the business at each key activity. It's a best practice, I think, to not only monitor that data, those metrics on a monthly and quarterly basis, but you also want to track those changes over time. So if I can calculate a monthly, quarterly average and then compare that to a rolling 12-month or 24-month period, am I getting better or am I getting worse? And if I'm getting worse, why am I getting worse? Is it a system problem? Is it a person problem? Is it a governance problem? And so if you do see some deterioration or a negative performance in some of those key metrics, then that would result in spinning up a project with various members of the committee to remediate that risk or to lower that risk profile. Third-party consultants or often used, or I've seen used in very focused activities. If I have a new policy or procedure implemented, I may see, specialist firms who will focus on coming in, picking up the policy, reading it, and then doing an independent audit, if you will, or review. There are third-party consultants that do specialize in valuation, for example, or in internal policies and controls. And so, some firms, larger firms, mid-sized firms, use it as a way to obviously, leverage their own employees, but also to learn best practices from these third-party consultants. Oftentimes, third-party consultants are staffed by former SEC staff, regulatory staff, examiners, auditors, former consultants, and so it's valuable to actually use them. Risk management software is a very general term within the industry. I think 5 to 7, 10 years ago, some firms were around trying to sell quote unquote, enterprise risk software. I'm a firm believer in ability of a group or a team to manage risk. You really need to manage data. And so if you have the ability to aggregate data on a firm-wide basis, if you think about all the data that you would need around, an investment firm, trading activity, compliance activity, things of that nature, as long as you can consolidate that into a framework where you can access it very quickly, it's in real time or near real time, it's clean data, it's been qualified, if you will, and I can, generate metrics on top of that, that will serve a very valuable purpose in managing risk within an organization.
Hey, Joe, I have just a follow-up question. You mentioned numerous categories of risk, some of which you can monitor on a relatively real-time basis by getting, as you said, clean data and data feeds, some of which are much more difficult to monitor on a real-time basis. I think you mentioned, tone at the top and culture of compliance, and
right.
A few others where you're not seeing any kind of data feed in. So how are you monitoring and tracking and quantifying risk for some of those softer risk issues where there's not data solution?
Yeah, sure. So a few that I've seen used for culture of compliance is to see the percentage of employees that are completing all their certifications on time, right, over time. If you have a very strong culture of compliance, you should have, 100% completion by all the appropriate dates. That's an easy one. Second is, for example, personal securities trading. If a firm does a very good job in communicating and educating their employees about their personal trading policy, you shouldn't have any violations. But if you do, why are you having those? Is it a communication issue? Is it a technology issue? Is it a training issue? So there are, ways to get at some of those softer or less quantifiable measures, if you will.
Joe, I was struck by a couple of the points you made about governance. One was the point about, you talked about a parent company. And I think in my experience over the years, a parent company's relationship with a subsidiary, let's say a parent company that was involved in financial services generally in a subsidiary that was in the investment management area, I didn't see that much interaction on risk management between parent and sub. It was the sub's business. But one area where I have seen more interaction these days is in the area of cybersecurity, where a parent company, by nature of its business, may have more expertise, may have more involvement in the area. And I'm starting to see subsidiary money management firms try to leverage off of the expertise there. Is that do you see the same trend?
Absolutely. So the parent-child relationship is one that's obviously very interesting. If I have a parent company with, one-to-many organizations, there's some common themes which impact all those subsidiaries. And one you hit on is cybersecurity and technology, or compliance, for example. And so what I've seen in the past is the chief risk officer, as part of the regular reporting regime, will meet periodically with the audit committee of the holding company and update them on, major initiatives or initiatives which do impact the broader organization. I've seen chief risk officers who have regular meetings with the partner of their primary audit firm for the organization, making sure that as part of the audit of the entire holding company that the chief risk officer is involved in helping identify areas where there may be some additional focus. Certainly cybersecurity is something which could impact entire organization, and in organizations where I believe it's a best practice, you do want to leverage risk people who have expertise in that area, who have experience in that area, both at the holding company as well as in the subsidiaries.
Yeah. I'm old school, so I worry about everything. And what troubles me about the parent company getting involved is I ask myself the question, so what if something happens that goes wrong at the subsidiary level, and say the regulator comes in and goes after the subsidiary for doing something wrong? Does the parent, by virtue of having its resources involved with the action, does the parent risk, pardon the pun, the involvement in an action? Would, for example, the SEC go after the parent company for aiding and abetting a violation? That sort of issue. There's not that much lore or law from the SEC, but there are some instances where the SEC's gone after a related company or parent company for what happened at the money management level.
So at this point, I'd like to ask Anne to talk about a recent survey that Wilkie conducted of ERM governance structures.
Sure, thanks, Laura. So I know this slide is a little bit difficult to read on the screen, but Laura has also included this as a separate attachment to the webinar, so you can definitely take this back. In this chart, we wanted to show the audience the different ways that advisory firms have structured their ERM governance. So a lot of this kind of mirrors what Joe had just talked about in terms of the different ways people can structure it. But first, you'll see that we try to get a broad range of the different types of managers, everywhere from a subsidiary of a large bank to publicly traded asset managers, and also our small to medium-sized registered investment advisors. Now, this is just a very small sample. We did look at a number of other different types of advisors, but it just didn't really fit on the page. But these are a few examples that we wanted to highlight. A few interesting things that, if you look at the structure that come out of it, there's no one size fits all, right? I think we mentioned that earlier. There's clearly no legal or regulatory requirement that the SEC has told you to structure your risk management ERM structure in a particular way. If anything, we think that the structure should be specifically tailored to your business. So if you have a smaller firm, it doesn't necessarily make sense for you to have a separate chief risk officer, and that could be perfectly fine depending on your particular risks in your business. Similar to what Joe mentioned, the larger asset managers you'll see do have a separate enterprise risk committee the members are the very C-level suite managers that are reporting up the chain. Not all managers have a designated CRO, but you'll see that the larger managers do have a chief risk officer. And another theme that we saw for the small to mid-sized managers is you'll notice that not everyone has a risk committee, not everyone has an ERM function, but that's okay. Depending on the size of the organization, that's perfectly fine. Another final interesting point that you'll see is the role of the chief compliance officer. And what we saw is not every CCO has a formal seat or voting, what you would call it, on the risk committee. I thought that was pretty interesting. I would have expected compliance to be involved in every ERM structure, and so it might have been a function of these particular managers that we saw. But I wanted to ask Rob, as the CCO, what do you think is your key role in terms of ERM, and do you think it makes more sense to have compliance have a critical role in ERM?
Yeah, and I think compliance has to have a role in ERM, and I'm surprised also by the survey results. I mean, I view compliance as being sort of the keeper of knowledge of regulatory risk across the firm, which is one of the most important areas of risk. And, compliance knows about the policies and procedures. Compliance knows about violations of those policies and procedures. Compliance is testing those policies and procedures, and is constantly assessing, the risk and the severity of the risks across the firm from a regulatory standpoint. So I think it's essential that compliance have a seat at the table in an enterprise risk management structure. And, in some cases, as Joe was mentioning, whether they run it or not, I guess doesn't really matter as long as their input is completely taken into account.
Yeah, from my perspective, an enterprise risk committee should be the senior-most control committee at an organization. And so therefore its members should be those individuals who run key control functions. So compliance, legal, risk, obviously, internal audit. IT, some example. You want all those people in the room when you're dealing with issues or you're discussing new controls or new risks. You want the brightest, smartest, most senior people in the organization focusing on those. And the Enterprise Risk Committee is a great way to do that.
And one of our attendees is asking whether the chart takes into consideration subsidiaries of publicly traded companies.
I don't think we had a specific example for that particular situation, but we definitely have seen that structure before, and we're happy to take that back and present that separately.
Thank you. So I'd like to move on and ask Joe on how a business continuity plan fits into the broader ERM program.
Sure. So as I mentioned before, part of the risk function is to understand all the activities within a business so that it's possible to actually quantify and understand those risks so that we can monitor and control them. And so given that knowledge and expertise, it's often necessary to have the risk team as part of the business continuity committee of a firm. If you are putting together a business continuity plan, you need to identify scenarios. And for each scenario, how am I going to recover that business? So if you think about the asset management business, we do some very basic things. We manage a client's cash. We manage their investments. We need to contact our employees. We need to contact our clients, and then we have an organization to run. And in order to implement a business continuity plan, you need to continue those functions. And so oftentimes the risk team has the most direct, specific knowledge about which activities need to be replicated in each one of your business scenarios. So how am I going to trade? How am I going to manage assets? How am I going to check compliance guidelines? So it's really, really important to have, the risk team involved in a firm-wide BCP plan. Oftentimes they're on the committee themselves, or they're on the, I've seen the risk team or the chief risk officer that sits on the business continuity committee for the entire firm. It's a really important functions. When you are looking at those activities of which to replicate, obviously you need to think about system issues. How am I going to access my systems remotely? And then the people. Where are those people going to work? And we're obviously seeing some of that currently given the COVID situation. So there's a lot of work which you have to go in planning perspective. And again, the risk team is well suited given their broad mandates and skill sets and expertise to really identify at very granular levels how a firm can recover should we have an outage.
Anyone else want to add anything to that? Well, Joe, you mentioned COVID, so Let me ask Joe and Rob, how has the COVID pandemic and just working from home long-term impacted ERM?
Yeah, it's been very, this has been a very interesting time. You know, I won't tell you how old I am, but I've been in the business a long time. Been through several credit crises and the dot-com bust and a couple mortgage crises, the credit crisis. This is extraordinary times that we're really working in. If you think about some firms, tens of thousands of employees who are working in offices around the company or around the country, around the globe, who are now working from homes. It is truly extraordinary, and I think it's really been a learning experience for a lot of firms where they have identified that they can operate the business with a much smaller physical footprint. A lot of it is dependent on firms, technology infrastructure and what their plans were. But I think there has been a big learning experience for some firms who are now in the process of rethinking their business continuity plans on a go-forward basis. And it's just not the technology. It's obviously the risk about getting people into offices in the future. If I have employees who live at homes with their elderly parents, do I want them in the offices or not? If I have an office in Midtown Manhattan and we open up the office, how am I going to get all those people in the office? What happens if my elevators are less than 6 feet wide? How do I queue people up outside the building if there's only a few elevators and I have a bunch of people in it? So there's all of these issues which have been identified, and in sitting in on a lot of calls, weekly calls and meetings with peer managers, lawmakers, regulators, it's not clear yet what the ultimate solution is. I think certainly we're going to see firms which much smaller physical footprints in offices. I think you'll see other firms using rotation programs. The one thing which has been an eye-opener for a lot of firms is, obviously firms have implemented their business continuity plans in order to operate this environment. What we're now working on is our business continuity plan for a business continuity plan. So, for example, we're getting into hurricane season on the East Coast. So what happens if we get a severe storm which knocks out power on the eastern seaboard? How am I going to be able to trade if I have employees who work from home, they lose power, they lose Wi-Fi? How do we recover the business? Same thing on the West Coast. We are subject to fires, earthquakes, other natural disasters. Again, if I lose power to a broad region of Southern California, Northern California, how do we recover the business? And so a lot of firms are now putting together BCP square plans, if you will, to identify how can I continue trading activities, investment management activities, critical functions across business regions to ensure that we do have the extra piece of continuity.
So, Laura, from a compliance standpoint, what I've seen, I don't know if this is a risk or not, but something that's affected the compliance program is a big part of compliance is actually walk around. And through walking around, you talk to your business people and you find out what's going on, and you find out about meetings, and you may find out about new products. Sort of as good as your communication network is, you're learning things by proximity to the business people. So how do we deal with that from home? And what I've told staff is you have to be overly proactive. So you need to be reaching out to business people on a daily basis, and multiple ones, not just at the top, but at the middle levels. In part to find out what's happening in business and new ideas and new products that may be coming along, but also to talk to them about what's happening from a compliance perspective. In a broker-dealer, a lot of people who want to work from home could have implications down the line in terms of a branch office, or, this is the IAA, so it's not as relevant, or an OSJ, or which would require visits. So there are regulatory overlays and implications in everything that the business is thinking about. from work from home, from part of the pandemic. And then there's compliance oversight that has to happen. And we in compliance have to figure out how to make that happen by being very communicative and very proactive and engaged in everything that's happening.
Rob, I was wondering in this environment whether, because compliance folks have to deal with so many issues that pop up that you would never have anticipated, do you think there's a concern, or there should be a concern, that it's harder to keep up with the regular risks that are out there, the more typical ones? I mean, I know the SEC has looked recently, the staff is concerned about MNPI and whether that's more of a problem now. That just seemed to me as a regular risk as opposed to something that's COVID related.
It's both, I think, Barry, something like MNPI. But the answer to the first part of your question is yes, you need to continue with your regular compliance program. You need people tasked with the functions, with whatever surveillance functions they're performing or whatever testing functions they're performing. The day-to-day compliance program has to continue, but it's got to kind of be supercharged. And so something like MNPI, where you're monitoring trading, firm trading and personal trading against restricted lists, and any other information that's relevant, you have this added component. I think Joe was mentioning this, where someone who has MNPI is working from their home with their family. And so those people have to be reminded, about a clean desk policy, about using codes, about not giving people access to their computers. So you have to conduct your regular compliance program, your regular MNPI monitoring, and then be thinking about what additional risks there are from working from home and from COVID.
It also strikes me, picking up on your last point about additional risk, it struck me that while we've been dealing with COVID-19 and related issues, we've seen some risks pop up for companies that you would never have thought about. One you alluded to about personnel not being able to get to an office in Midtown Manhattan. That was clearly an issue we had to deal with, whether certain functions couldn't be undertaken there, so that it had to be moved. The other one that has been really, it was a surprise for me, because I wouldn't have anticipated it, although I think people have come up with ways of dealing with it, are parties that are part of the asset management business that you don't think of as parties, but are very important. So for example, for a while we had problems with printers who could not put together the documents that needed to be filed with the SEC or sent out in hard copy out to investors. And who would ever thought that would have been a risk you would have faced, but it is. And it came out of this environment. Cybersecurity kind of issues, much more now out of COVID-19 than we would have seen before. Joe mentioned communication systems, and they're working or not working. What do you do in that situation? The list is sort of endless.
Great points. Does anyone have any final thoughts before we wrap up?
I think COVID-19 and dealing with it is going to cause more companies to be more interested in ERM on a going forward basis.
I would agree with that. Absolutely.
Yeah. Barry, you raised a really interesting, Laura, we have time, or do we have 1 minute?
Yeah, we have about a minute.
Okay, so you raised a really interesting question about something like cybersecurity coming from the parent company and whether that could be seen as aiding and abetting. So I've been thinking about that, and from a practical standpoint, it makes so much sense. You wouldn't want to recreate a cyber program within each, let's say, regulated entity. You'd want to have shared services at the parent. Each regulated entity has their own individual responsibilities with respect to cyber, for example, and you can't delegate away that responsibility. So the regulated entity, I think, would have the responsibility. You're right. It does expose the parent company to some, potential risk, but I'm just not sure how to avoid that, because I think it's essential that you have the entity with the most resources provide that kind of knowledge.
Yeah, I think what you have to do as a practical matter in that kind of situation is weigh the risk potential against the benefit. I think when you do that, you end up concluding that the benefit outweighs the risk. But you need to consider, I think you need to consider the risk as a parent company does that. That's really the general point.
Great, so we'll end there, but I'd like to thank Barry Barbash and Ann Cho from Wilkie, and Joe Bershinger and Rob Saperstein from Guggenheim very much for all of your excellent insights. We really appreciate your participation in this webinar. Please take a minute to fill out the very brief survey that should pop up. And with that, thank you for participating, and that concludes this webinar.
Thanks for having us.
Thank
Thank
you.
you very much.